Hey, what's up, guys? Matt Atwood from Timewise Financial, and today I want to give you guys an update of what's been going on in the market, i.e., the economy, and what we expect to happen going forward. So, we're going to cover where the market stands today, inflation as of late and looking forward, how inflation has affected rates, and what rates have done to the economy as well as each of your individual investments. So let's start off by looking at the economy as a whole. So GDP, or gross domestic product, is a really good measure of overall economic activity. And essentially, it's every dollar spent on goods, services, construction, real estate, cars, any category you can think of aggregated. And so when more things are bought, that means more things are being produced and an economy's growing. And when that number comes down, it means an economy shrinking. So as of late, GDP came in at 1.6% year over year in Q1 of 2024. That was much lower than initial expectations, which were closer to 2.5%. And that being said, through the end of the year, they're expecting GDP to end at 2.6% year over year. So a good bit higher. If you think about the grand scale of the American economy, a 1% difference is a huge amount of dollars and economic activity. And so typically when you see inflation, when things starting to cost more, you'd want to see pretty healthy GDP as well, because that means people are still spending the same amount of their dollars on goods and services. So it's a little more concerning when you see inflation high and the economy stagnating, because what that means is goods aren't getting any cheaper, but people are buying it nearly as much, and it puts a downward pressure on the overall market and economy. So where is inflation? Inflation currently sits at about 3.5% as of last month. So I'm sure each and every one of you guys are feeling this when you go to the supermarket or go get gas or all these things that you and I typically buy. Even shelter is a lot more expensive than it was even last year, but more so prior to the pandemic. And it hasn't really let up. And the Fed has a goal of 2% GDP and 2% inflation. And they've stated that you probably won't see any rate cuts unless they can get inflation down to 2%. Originally, they forecasted it not taking nearly as long as it has to get inflation to that target, but inflation's being sticky. The good news is the consumer's still spending money. The bad news is, to fight this inflation, the Federal Reserve has hiked interest rates exorbitantly. Now, we've talked about this for the last 2 years, and it's crazy. Inflation and rate hikes have been the key driver of the economy and all of the factors at play for really the last 4 years since the pandemic hit, when we dropped rates to the floor, printed a bunch of money, and then had to fix our mess by paying a lot more interest, getting this inflation under control. So rates sit around 5.5%. But what does that mean exactly when we say, rates are at 5.5%? Because you and I aren't seeing that in our savings accounts. You and I aren't seeing that when we have go borrow money to buy a car or buy a house. We're paying a lot more than that, and we're not getting nearly close to that in our savings instruments. So what that means is the Fed sets a rate for banks to borrow money from the Fed. The Fed prints all the money. The banks take some of that money and lend it to us, with a profit in the middle. And so if the Fed's charging banks 5.5%, you're going to see a premium on there for you and I, or a spread. That's why you're seeing mortgage rates at, 7, 8%. You're seeing car loans at anywhere from 9 to 13%, is because the banks are having to pay a lot more to borrow money, i.e., we are too. And the Fed and all of us would think, hey, if money is 3, 4, sometimes even 5 times more expensive to borrow, you and I probably aren't going to be nearly as incentivized to borrow money and buy things like cars and houses and do remodels and buy stuff from Home Depot and charge it to our store card at really exorbitant interest rates. And up until now, that hasn't necessarily been the outcome. A lot of Americans, I think, kind of had this pent up demand coming out of the pandemic, and it definitely highlighted I guess, the finite nature of each and every one of our lives. And so you saw this spending spree occur. But now each and every consumer is starting to get a little over levered, and they're starting to cut back. Essentially, they might not have any more cash flow in their monthly budget to spend on another payment on a car or a house or something like that. And so for that reason, we're starting to see GDP, economic activity, come down, but we aren't seeing prices come down nearly as quickly in correlation to that economic cooling. So looking forward, seeing the GDP come down is an indicator that inflation should follow suit. But until we see that inflation hit 2%, I wouldn't be surprised if you don't see rate cuts, and not nearly as many as anticipated. So looking at the first of the year, even first of 2024, there were as many as 6 rate cuts forecasted this year, which would be a welcome reprieve. You got to think, your Facebooks, your Microsofts, you and I, we make decisions off of how much is it going to cost. And if it's going to cost a lot more money to borrow cash to go buy something, those companies and you and I are typically going to cut back. But as soon as rates start to come down, you and I and those companies would be expected to start spending more money. And so the market is sitting here tapping its feet, just waiting for rates to start to come down. And each time that can gets kicked a little further, it drives more uncertainty. Is inflation here for good? How are we going to get a hold of it? And that uncertainty is why at the beginning of this quarter, we saw some choppy waters in the economy. That, combined with the fact that tech stocks last year went on a unbelievable run, the largest run probably since the dot-com bubble. And the reason being for that run was artificial intelligence. There was this high speculation that AI was going to take all of our jobs, and we were going to sit at home, get picked up by a self-driven car, and go to a restaurant that had a bunch of robots serving us, and no one would have any labor costs going forward. The market got really excited by those prospects because that would be more profitable in the short run. But in reality, AI isn't necessarily taking off as quickly as initially anticipated. Some of you guys might have interacted with ChatGPT or at least heard of it. And it's exceptionally well at answering a question. Typically you would go to Google, type in a question, and maybe scour through 5 or 10 results to find the best answer. ChatGPT doesn't do too bad of a job at refining those results and getting you one answer. But the real question is, how much of an enhancement is that technology to what we had already existing? It's great that it can refine Google results. It's great that it can generate an image that you might have to go sift through on Google Images. But how will that totally alter how you and I interact in the marketplace as consumers? And that's still to be determined. There's plenty of stories out there of people over-promising the capabilities of ChatGPT or artificial intelligence. You can look at Tesla. Many people bought cars 3, 4, 5 years ago with the promise of self-driving being rolled out, 6 months after their purchase. Well, still, they have to have some input on that wheel. There's not many cars that are running without any accidents that can just pick you up and not have a single driver in the car. So it's important to realize sometimes these technologies that get touted to be life-changing, world-altering, take a little longer than the folks selling them to the marketplace initially quote. So it'll be interesting to see how that takes place, but that long transition time is why the market started to get a little spooked. Additionally, when you look at these chip manufacturers like Nvidia, you might have heard of, went on a huge run in 2023. The majority of folks buying those chips from Nvidia aren't me, your neighbor. It's these huge companies like Microsoft, Google, Facebook, Apple that are trying to take advantage of this new computing technology of artificial intelligence and utilizing these chips to expand their platforms. But the issue is they bought a ton of chips last year, and now they're investing in utilizing those chips to develop AI. But they've essentially had all their orders filled. And so the market's starting to get a bit skeptical about, hey, well, if they essentially have all the chips they need and they were some of the only buyers of those chips, what are Nvidia's revenues going to look like a year from now? And so you saw some of those stocks really pull back at the beginning of the first quarter. The good news is, one, they drew the market up last year. We had an exceptional year last year. But two, there's companies like utility stocks that have done exceptionally well this year, because if this AI and these self-driving cars do take off, what are they going to need to produce power? They're going to need utility companies and the power that they produce. And so you've seen utilities, a very beaten down sector of the market, do exceptionally well so far this year. And there's a ton of other undervalued stocks relative to these really high value growth stocks that were flat or down last year. And so out of 500 stocks in the S&P 500, 7 of them did exceptionally well last year. The other 493 could very well have a time to shine going into this year. Additionally, we've got an election coming up, and when the market faces uncertainty, they don't know whose rules they're going to be faced to play by in the next 4 years. You'll see volatility pick up. The market doesn't like when whatever is going to happen next is uncertain. And so typically you're going to see volatility, or that roller coaster ride, pick up from the 6 to 12 months leading up to the election. And historically, it really doesn't matter which rules are announced or who wins that election. But once that certainty is provided as to which set of rules the market's going to be forced to play by, you'll see a rally in the corresponding sectors. And the market as a whole will typically, in the 6 to 12 months after an election, after that uncertainty has been resolved, see a much fairer sky to fly through. Additionally, we've got some cracks in the facade. The credit card delinquencies, for one, are on the rise. The consumer has spent a ton of money in the last few years in this post-COVID economy, and some of those consumers are starting to get stretched thin. The good news is, as long as their checks keep cashing, meaning their paychecks, we don't see any real cause for concern on that front. Unemployment is still at relatively extremely low numbers, around 3.6%. And some would argue that just typical people being out of work or getting counted in the equation because they're taking a break from work or whatever they might look like, run somewhere on 4 to 5%. And so we really don't get worried until we start to see north of 5% unemployment. And as long as each employee has a paycheck coming in, they're going to keep buying stuff and they're going to keep paying their bills, which is really what goes to support all these stock valuations on Wall Street. So as we look through the end of the year, we'll definitely have some highlights. As borrowing costs are elevated, we're getting a lot more interest in our time deposits and our bond side of the portfolio. And then as the market gets rewarded with those rate cuts at some point in the future, that will be stimulative as well, because you can only expect when money gets cheaper to borrow, people are going to buy more goods and services. That being said, if you have any questions about what's going on in the market, how it might affect you, how it might affect your portfolio or your ability to retire, we really hope you'll give us a shout. Shoot us an email. All our contact info will be at the end of this video. And otherwise, we really appreciate you taking the time to tune in, and we'll see you next time.